I have a very interesting case study about financial freedom to share with you. And to conceal her real identity, let's call her Alice. Alice actually dropped me this email. I recently chanced upon your blog and started following you since. Just dropping a note to say great job for sharing and educating readers and followers about financial planning and investment. I was also a graduate from NTO Accountancy, but probably a decade before you. It's true, I come from NTO Accountancy. I think I graduated in 2008, if I'm not wrong. And what I remember is that accountancy really honed my skills in understanding a balance sheet well. And that also applies to investing, correct? Because investing is not just hearing ideas or hot tips. It's about really trying to get a good grasp of a company's balance sheet, profitability, and making a judgment. Because when you invest, you need to have conviction. So the conviction is actually derived from studying the books, pouring hours towards it. But back to the story. On a side note, I've decided to retire this year and I'm in my late 40s. And based on my financial numbers and net worth of about 3 million, I should roughly have enough to start my FIRE journey. Congrats to Alice. I think late 40s is still very early in Singapore's context already. Many of your readers have asked for examples of people who can FIRE with kids. Absolutely. You know, when I did a previous video, one of the common feedback was that, oh, they don't have children, that's why they can retire early, what? True, but also not the entire story, correct? Children do bring extra costs to a family, but ultimately it's how much you can save on a per month basis and ultimately how much you can invest and build for your nest egg, what? So it's not just children only. So I suppose my example should demonstrate that FIRE is possible even with kids, as long as there's no lifestyle creep with diligent saving and investing done along the way. Well said, lifestyle creep is the first thing that you need to take note of, especially for younger adults with the new first paycheck. I always advocate to actually all my private clients' children also, set aside a portion as forced savings and we'll dollar cost average with that. Then they will just be spending whatever balance they have of their first paycheck. And once this habit builds, as their pay increases, you realize that they can invest more and more. And financial freedom in 40s, as what we learned today, is very possible. But I want to quiz Alice on exactly how much she has right now, correct? And how she has invested. So let's start with her house. My house is valued at 950,000 with a mortgage left of 410,000. So I factored 50% of this, which is 270,000, into my net worth. Of course, that seems to be less than 10% of total net worth. So pausing on here, I will guess that this has to be a 4 or 5 room HDB flat, correct? If not, you wouldn't be close to $1 million. And I'm also curious, mortgage left of $410,000. Does that mean that the house is pretty new? Because if this was her first house, and she's late 40s, if she had only for 20 plus years, I would guess that mortgage is cleared much lower already. So this could be her second house. Again, that's my own guess because I see cases on a weekly basis, right? So these are things that immediately ring a bell in my mind when I think through some numbers. So let's look at some of her CPF and SRS. She has shared that it's $1 million, part of which is OA and all of SRS that's invested in the stocks and ETF. She has some real estate portfolio, cash value of insurance products, and liquid assets, cash, stocks, bonds of $1.5 million. So that actually works out to how she built her $3 million. But I'd like to pause at the first part. More than 1 million of OA and SRS. I think SRS, what I've seen biggest, is only $300,000+. My own SRS is around there. I actually haven't seen a 500,000 SRS yet. So I would guess that it has to be like 700,000 of OA and 300,000 SRS, correct? Again, I'm guessing again, but 700,000 of OA seems a big number for late 40s. I'm not sure you can get there. Or is this a combination of OA and SA or not? Then 700,000 is possible because SA, someone could have 250,000, OA 450,000. But that also means that OA is not used to pay house, right? If not, there wouldn't be so much. Unless, of course, she's referring to future value, which I don't think so. So I've tried to piece on the puzzle of how there is more than $1 million. Or she's invested super well. Then the rate of return 10% compounded. yeah, then we might get very big amounts in OA and SRS. But I've actually haven't seen that many case studies with that big a amount. Then some real estate portfolio. Does this mean that this real estate portfolio, if we less off house, if we less off OA SRS, if we less off liquid cash, this real estate portfolio is like 200,000-300,000? Then it has to be like either Malaysian property or, broadly speaking, overseas property, or also industrial property. Then that could be what she's meaning in real estate portfolio. But more importantly, current liquid assets of $1.5 million. That is a fantastic figure to have, and I guess in this discussion we'll unravel it a bit more and look for numbers, lessons to help you in your journey, correct? So don't see a big number and zone out. Look for lessons. We all come from different backgrounds, but if we can take learning points, you can be better off in your journey also. And that's why we built this story together. And thankfully, Alice has been kind enough to continue sharing with me numbers as I probe with her in this email. So let me next address questions. What are learning lessons from her investment journeys as well as mistakes? The first thing she mentioned is position size is important as she wants to avoid big losses which will take a long time to recover. Absolutely true. And that's why for myself, I don't over concentrate in any sector. If I bought purely China only, then big problem. Right now, only a break even. I also don't concentrate too much on an individual name. One classic thing that I've shared very openly with you on this channel, nothing to hide, is my allocation towards Mapletree Industrial Trust. Right now, it doesn't look very nice. With dividends, I probably am still slightly below water. So Mapletree Industrial Trust, I couldn't keep doubling down as it trended downwards, correct? Again, that's to prevent being overconfident. Again, that's to prevent, decimating the portfolio, because we don't know what we don't know. That's the truth. Even for Warren Buffett, he has made mistakes before. Like Paramount, which is an investment, he's lost more than 50% even. So even the best of us make mistakes. But as always, the investment game is to have your winners way bigger than your losers. And for myself, I see Mapletree Industrial Trust like I'm farming like that. Right now, the crop isn't growing well. I'm also a bit worried. I'm also a bit impatient. But I think I can't get angry with it, right? Just wait. There will be sunshine eventually. And my game plan is I cannot keep plowing the same seeds and can get angry and scold it for not growing well. I need to plant other seeds and give it even more time. A lot of times we fight our own impatience. One fine day when the sun comes shining down, it will go up already. And that's what we see also in China, Hong Kong tech, which is right now on a bull-leg recovery. Let's continue on with what Alice has shared. Her biggest drawdown is 50% of past as she owns stocks, not ETFs, which I think she's suggesting she's not diversified broadly. It is true when you own individual stocks, 50% drawdowns, very, very possible. You need to be comfortable stomaching it, especially in tech sector in US. So that's another thing. She should just close her brokerage app and not look at it, and she never sell at lows. Unrealized drawdown is like fully prime HDB. Just hold on to it. That's true. Sometimes with a good brokerage app like Moomoo, we would be always looking at our P&L, worrying about the next day's price. So sometimes overlooking it because it's so easy to use can be a pros and cons. Can be a help or also a detriment. And let's read on further. Not sure how my emotions moving forward with such drawdowns. And she is now preparing 2 years of emergency cash. Wow, that would mean 100 or 200,000 in cash, correct? And she's not sure also whether she should switch to investing in ETFs instead of stock picking, which is just the game theory of broad-based versus individual stocks. I would address this towards the end of this discussion, correct? So hold on for it. Now, I next quiz her. Hey Alice, what's your biggest investment gains and what is the story behind it? Because we want to find out how to build 1.5 million, right? It can't be purely through savings. That would be a little bit optimistic. So there has to be some gains. Once you have some 5 to 10% rate of return, you would realize that compounding would shorten your journey massively. Alice has shared, no big multi-baggers. Overall, more gains than losses over the last 14, 15 years of investing. Absolutely true. More gains than losses. Very simple game plan. You would realize that you can actually compound wealth pretty easily. But also, she's invested 14 or 15 years. If we work backwards, that means she started investing only in 30s. So if you are starting earlier right now at 18 years old, congrats, you have a lot more time to accumulate knowledge and to start this compounding journey. It's never too late to start investing, and if you want to start, Moomoo is one of the easiest choice for beginners. It's very mobile friendly, and you can see having a good device like this Oppo Find N5 makes the entire investing experience so easy. I'd like to do a quick share on how you can use Moomoo on this special phone. It's designed to be the thinnest book-style foldable phone with exceptional battery life. This is my boy and he loves it. Now with that, let me show you a special glimpse also into my Moomoo account using this phone. Now if you are a new investor, let me demo for you how to deposit money to get started in the investment journey. It's very simple. Within 1 minute, I've added in more funds, as you can see over here. And if you want to invest into S&P 500 or US stocks, you need to do currency exchange, correct? So within Moomoo, it's very simple and you won't experience delays. And if you're thinking now, hey Josh, I'm new to investing, what should I start with? Very common question. I've seen it also in my Telegram group. I'll leave links below for you to join in. I would always suggest to go slow and steady by dollar cost averaging. And how to do so in Moomoo is through this regular savings plan option by clicking on this RSP. Straight away, you get popular options suggested to you, and if you like it, simply click on it. You can start with as low as $5 and set up hassle-free automation. Moomoo SG is really one of the most flexible investment schedules. You can put daily, weekly, monthly, adjust, pause, or stop the plan anytime, and with that, you can systematically lower your average investing costs. Now, we've discussed on Singapore stocks in today's video, correct? And let me show you how to invest for dividends. You can see analyst rating, Morningstar research, and even valuations to make easy investment decisions. Want to find out their dividends? Very easy. History breakdown as well as the payout dates, all within Moomoo's platform. And don't you think it looks so beautiful on Oppo Find N5's split screen? How about a different name? How about Propnex? If you want more news, simply click here to get all the updates whenever you need. So Moomoo is indeed one of the best platforms with lifetime $0 commissions for US stocks and $0 for 30 days on Hong Kong or Singapore stocks. So if you're interested and you're new to Moomoo, look for my sign up links below to get $820 worth of welcome rewards. So what are you waiting for? Look for my links below to sign up today. Thank you very much for support, and let's get back to Alice's story. She's also shared that she made good returns from locally invested ideas, Baustit, which I also have, Sarin Tech, that was pretty popular 10 years ago, Centurion, which I sold off but continued to climb, as you can see the chart over here. So we never know where the peak is. So myself, I always eat humbling pie. I did make a bagger from Centurion, but it's still climbing, which means I've missed out opportunity. Adam Pack, Banks, STE, probably ST Engineering, AEM has swung up and down, and iFast, which I also own. Then she's expanded from SGX investing to US equities and some multi-baggers. C Limited, of which you can see the chart over here, big yo-yo upwards, correct? And then unfortunately a big crash. That's why more than 50% downside is possible. But C Limited seems to be recovering already. And CrowdStrike, also another tech name in the cybersecurity space that has seen a very big volatility in share price. I quizzed her next on her income. You know, I'm always very capable about finances, and everything starts from income and savings. So we must get to the root of things. Ask Alice what was her career over the last 20 plus years. And anyway, it was from same NTO accounting, right? I would guess that she probably started in audit firm. That's where most of my friends went to. External audit, then after that, typically moved to internal audit. But in an accounting background or audit background or audit career, there's a lot of stability and career progression is pretty strong. Alice has shared, in her 20s, her initial pay was $2,100 only. It's true, fresh graduates accountancy in big four firms were paid peanuts. That's why I hear I didn't go inside. I started doing sales immediately. And max of $4,000 at late 20s. Today's fresh grads are earning more than $4,000 already. So different world. Income in her 30s and savings ratio. She restarted work as a working mom in late 20s at $50,000 only. And that quickly increased to $90,000 in 2 years. She must have job hop, I guess. Probably again moving from external audit to internal audit. And because of working mother relief, she paid low taxes. It is true, in yesteryears, tax relief had no cap. Right now, there's 80,000 cap only. High income moms last time were really paying very little once they have this working mother relief. So her savings rate was 30 to 50%. And when her kid was in preschool or primary school, her annual expenses were only 60,000 thereabouts. So 30 to 50% with a kid and in 30s. So use that as something as a feedback. Maybe you're in a situation right now like that. See if you can learn from this and be a bit more frugal to save up more money. Then in her late 30s, her income grew to 200,000 and she continued to enjoy this level of income until she retired. Expenses only increased from 60,000 to 70, 80,000. That means that savings rates shot up to 65 or 75%. First guess, promotion. Now become manager already or even a CFO. That's why income jumped. So right now, if you're thinking, how does someone grow income? As you can see, early 30s to her late 30s, very different landscape, correct? It is possible once you have right promotions, and that's after you've honed your skills. So be optimistic. Maybe your big promotion is around the corner. But what we can learn is expenses were capped and therefore her savings rate shot up, correct? I've actually shared this before. I've seen it in my own journey, but right now we get a third party to share with us. It's absolutely possible. So I'm not blowing smoke in your face. This is what I've done in my journey also, and right now I'm also saving 70% easily of my income. Then in her early 40s, especially in the last 2 years, she traveled more to Europe, do a bit more work trip extensions, can have fun already lah. So as you grow older, time is limited. And her kid had more tuition costs, JC tuition, very expensive, I know. And at her peak expenditure was like $110,000 until he did his O-levels. That brought savings rate down to 50%. So we can see a real journey. Some people do save 100,000 easily a year. It is true. And if you have been on this journey before, share with us in the comment sections what you saw or what are learning lessons that we can all spread to our younger audiences together. She started topping up her SA in late 30s when her income is higher. SA was maxed out within 4 years. Fantastic. For myself, I am topping up SA for tax relief. So I do believe I can beat 4% real return, but the tax relief part is now really, really very important. So if the measure of compounding, her SA at current growth from 280 to more than 400,000. That is true, and that will definitely help her in her retirement. Overall savings in this journey has been 30 to 70%, an average of 50% throughout 30s to 40s. This reinforces again. If we do an estimate, she was saving 50 to 100,000 every year, and she worked for at least 15 years at this peak. That means that $1 million can be saved up, correct? And that actually is the first foundation that allowed her to invest, which eventually builds her 1.5 million in cash bonds and stocks. And that also allowed her to own other assets, such as her CPF savings, such as SR savings, and her real estate portfolio, which she hasn't shared with us too much. So to that point, I'm also curious next. Alice, of this $3 million, double confirm, is it purely your net worth or does it include your husband's? And with that, we can kind of forecast, is she financially free based on her expenses today? She replied, the $3 million is only hers, although she does share expenses right now still with her husband for the family's needs. And she's kindly shared that his own CPF is also very well built with more than 900,000 SA maxed out, and he's still working and contributing to it right now. So from a family net worth perspective, we could guess that it could be 5 million or slightly above. So again, there are families who have built great wealth staying in HDB flats, and they are very happy with a simple lifestyle. Next question on her current expenses, and I actually quizzed her to share a deeper breakdown. My question was, how do you keep expenses low now, and do you have a breakdown to share? Her reply was, would you consider my expenses low? Actually, maybe my low now seems a bit out of context because I didn't know her income and her family. So actually may not be low. So what are typical expenses for a working parent among your private clients? For 2024, her peak, which was peak expenses of 115,000, household expenses was 16%, maybe 20,000. Still very little considering they have one kid, which is 3 in the household. Insurance costs 15,000. Wow, that's quite a bit. Parent allowance 14,000. That's also quite a bit. And mortgage of 14,000. To this point, mortgage 14,000 it doesn't quite tally with her outstanding, correct? Just now we discovered it's 400 plus thousand. Is this 14,000 purely by cash, which means that her OA is used? If not, 14,000 per year can't really clear 400,000 loan. So that part I'm not too sure. But again, we were guessing that her OA is not used for housing. If not, you wouldn't have built up to such an amount, correct? So there's also travel, which is 12,000. Income tax, at least 10 plus thousand, which makes sense. School tuition, 6,000. Maid and car related costs. For 2025, her budget is 75,000. And she's kindly shared that her son now is in army. Completed A-levels already, congrats. And a reason why her expenses would drop. Right now, it could come down by a third. And right now, she doesn't have any helper already. Car loan fully paid already. And no more school tuition fees of 7,000 per year. $7,000 per year for one kid. So in Singapore already, we spend a lot on children's enrichment and tuition. Lower travel budget, and because there's no more company benefits, there could be some step-ups in medical screening and dental, etc. And of this breakdown, I actually would like quiz. Insurance cost of 15,000. What exactly is inside the insurance premium? Because that seems a lot. Are there some parts that would complete premium soon? Because this 15,000 hopefully is not until 70 years old. I don't know full details, and as always do speak to a qualified advisor first. And of this entire breakdown, I haven't seen also her personal expenses. I'm sure that there's some cost for haircut, facial, gym, etc. So personal expenses are not shown here. I'm also curious. Last but not least, her expense forecast for next year, with income tax fully dropping off, could be as low as 65,000, which is about 5,000 per month. 5,000 per month, if we use the Financial Freedom Index, that means 25 times of annual expenses, correct? That will be like $1.6, $1.7 million. $3 million worth of assets, she's definitely financially free already. So with that, I can next answer her question. I would like to tap your financial planning expertise regarding my investment strategy, and welcome to poke holes or suggestions, or if she has any blind spots, do highlight it. Okay, based on my total portfolio return, I base it on $2.3 million, just including liquid assets, CPF and SRS, and I assume overall portfolio return of 5%. That will give a capital gain of 110,000 to 120,000, which exceeds her annual expenses. That is true, and maybe I'll take a pause over there. If we include CPF and SRS, maybe that complicates the equation a little bit. Because as we know, CPF, only the amount above full lump sum is liquid and only at 55. SRS, only liquid after 62. If retirement now in late 40s to 55, there could still be a gap that needs other assets. Which means, could we simplify and see from just the 1.5 million of cash, bonds and stocks to determine if she can have surpluses instead of using the entire 2.3 million base? And just now we understood, she's targeting like 65 or maybe 75,000 of expenses, correct? That means that if we have a 5% return rate, 1.5 million theoretically can fulfill that. But again, 5% return rate, we don't know the details of it. We don't know how much is in stocks, we don't know how much is in bonds, we also don't know how much is in cash. Cash right now, optimistically, is only 2-3%. Bonds, not too sure also. Stocks, maybe yes, but all in all, this blend must have 5%, and probably we need more details to determine whether it's realistic. And also, it's her own investment experience so far based on her investment skill. Theoretically, the whole portfolio could grow as she taps on retirement. 5% compounded rate she feels is conservative, as she blends in 6% return for stocks and 40% on the bond portfolio, which she believes is CPF. Actually, CPF after 55 becomes 2.5%, the surplus. That's unless we transfer to RA, which again distorts how we can use, because RA account again pays from 65 and it's an annuity structure. So hopefully she has a track record that she knows herself that 6% is actually very doable. Based on the withdrawal rates, 75,000, she measures it and feels that likely she's okay. In 4 years' time, she'll also have an endowment that will mature and add 180,000 to asset base. Any inheritance is also not considered yet. Maybe let's take a pause over there. I think this endowment might be inflating her insurance premium, which means also this endowment will complete at some point, 4 years. And her expenses are actually not going to be that high because that factor in insurance premium. And to this point of endowment, this is actually another safe asset. Does that mean that she need not have so much liquid cash of 2 years? Because if not, there's too much of safe assets, correct? Then the next part also is inheritance assets are not considered. Many of my private clients have also this question, and usually we do project without that factor coming in. But the reality is that many families actually have inheritance, and that brings about lump sums that come into the equation. And if one is not savvy with investments, such lump sums can be very scary to handle. And that's what I address with private clients a lot. If you happen to be in a situation like this, know how to maximize your inheritance properly. Look for my links below. I can help you build a proper retirement ladder that suits your investment experience and suits also your risk appetite. These are some raving reviews I've gotten from private clients. And as always, again, look for my links below. If you want to engage me on a fee base, I do have limited slots for private clients only. Do not disturb the asset compounding growth strategy. I've set aside 2 years of cash to avoid any sell down during bear markets. And so far, she hasn't sold down. Now back to the story. There's also this 2 year of savings, correct? I think that relates a bit to the bucket theory that I've described before, and I'll leave towards the end of this video. Look at it this way. Your first bucket, let it be in liquid cash. Stock markets go down, don't worry about it. Then what you do is your assets in equities be in other buckets where you have longer term horizon. And when they do well, you funnel them towards this first bucket in cash. When they don't do well, you hold on to it and deplete your cash first bucket, because all bear markets will end at some point, correct? So if you'd like to find more, I'll leave links again towards the end of this. But coming to here, I like to leave my own conclusions, because she tasked me to give her feedback. And my first input again is, she is in good hands. No problem about retirement. In fact, I'm very happy for her that she's chosen to not chase more money or take this path of retiring. But also I like to balance it with another emotional point. Right now, she might be a stay-home mom when kid is already in NS. There may not be a lot of things to do at home. So maybe the next part about resting for a year or two is that it's time to revisit work in a more relaxed manner. Can that be sideline income or not? Find some joy contributing and bring in that little bit of income, and you realize the retirement equation looks even better already. So when getting to that space, it's a nice feeling to have. And more importantly, she's articulated throughout this whole discussion that she feels she has enough. And emotionally, that's very important. That's something I also feel, because I do feel I have enough at this current juncture, and I'm at peace of not chasing more and more money. Enough again is a state of mind. Enough for someone can be 3 million. Enough for someone else could be just 500,000. We all have our different expectations, and again, enough, let it be what your heart tells you to be. Then the next part about her investment strategy. She has suggested worry that she don't know how she'll feel in her drawdown. Maybe this is time to really move more broad-based instead of individual stocks. Again, individual stocks we invest for dividends, that's fine. But if you have individual stocks like C Limited, which don't pay you dividend, you would realize that when is the time to sell? Not sure what, growth stocks especially. Having too much of it puts a burden on understanding when to sell. When you're broad-based, which is to buy an entire index or world equities in general, you realize that selling is just a timing thing. The rest, you stay invested, time's up, sell a portion. That's why I also advise in private clients. And that's why I'm also doing for my own SRS. I'm moving it from individual stocks to a more broad-based portfolio, so that when we have the SRS window to sell now, it's a lot neater. I don't need to think which stock to sell, I just sell on the percentage on the overall portfolio. At least if you're watching this, maybe I'll suggest the first place to start is your SRS. Move it more broad-based first, and then bit by bit streamline your stocks portfolio. Keep those that especially are going to pay you dividends, like banks, ST Engineering. Then the rest, not too sure one, move them broad-based. Maybe this is useful food for thought. And as always, if you enjoyed this discussion, smash the like button, smash the subscribe as we march towards 70,000 subscribers. Check out my sponsors for today, Moomoo and Oppo. Just now I gave a glimpse of something called the bucket theory for retirement. If you haven't seen that, check it out. I think you will have interesting insights. With that, I'll see you there. Take care as always. Goodbye.